Here's something I did not expect. I went back through 22 years worth of our squeeze trades, nearly 6,000 of them, and more than half of these 6,000 trades never pulled back at all. They just took off from the moment the Slingshot Squeeze triggered. And most of those ended up being the best trades in the entire data set. Now that's a little awkward for me because the advice that I personally have always not only given but have been given, and you've probably been heard, is to wait for the pullback before you get in. So I want to walk you through what all of this data actually says about that because honestly, I think it should change and affect a little bit about how you manage your entries. And just so you know where I'm coming from, this is the kind of study and research that we've baked in when we've built the Squeeze Setups platform. So what you're about to see is already inside of the platform and is part of the research that helps make finding the best squeezes easy. Now, before I show you a single number, I want to be really clear about what we're testing here first, because if the claim is fuzzy, then none of this really means much. The advice is basically this. Once a squeeze sets up, that means you see either the red, the black, or the yellow dots, you're better off waiting for the stock to dip back towards some sort of a pullback zone before you actually enter. The premise is you can skew the risk to reward this way, you get a better entry price, and usually it means a smaller risk for a larger reward. Now, with this entire idea, you're making two key assumptions, and we need to call those out. First assumption is that this pullback actually shows up. If that never shows up, then this entire premise of a pullback holds no weight. Second assumption is that the deeper a pullback usually means the better the deal you're getting. That would make sense using logic. The data has something to say about both of these assumptions though, so I'm going to take each one at a time and we'll walk through how first the trade works and then what happens when you layer on the pullback. Now, if you're newer to squeeze trading, here's a very quick foundation on what the squeeze is and how you can use it to trade. The actual entry for this particular exercise that I used was the Slingshot Squeeze trigger. That, for all of our Volatility Box members, if you've ever seen the squeeze course, that's the yellow arrow that we're looking at in our Thinkorswim chart. It's also available on TradingView. What that tells us is that the stock is squeezed. We have the moving averages that are lining up and supporting in the direction of the trend, and we even have momentum that is starting to turn back up. So you're getting in while the squeeze is still coiled and building, not after the squeeze has already fired. Now, the exit is when that squeeze actually fires and all of this energy that's been building up releases. And the one thing in this entire exercise that I measured is the level that I'm going to call pullback depth. That's the variable which measures how far did we see any kind of pullback before the squeeze actually fired. And this pullback depth is going to measure the deepest price went against you between the two data points that I just talked about, the point of entry and the point of exit. Now we're going to measure this in terms of ATRs, the average true range. I use ATRs in this particular research exercise mostly because it helps even out the playing field. A calm stock and a wild stock both end up giving us useful information here, and ATR allows us to make sense of that on a relative scale. Now let's take a look at the data. The sample size of this entire Slingshot Squeeze data set that we took a look at for this exercise was 5,852 trades. That goes all the way back to about 2004 and covers to this year, 2026. This also includes the 2008 crash, COVID, all of it. So lots of different market regimes, lots of different times that we had a bull market, a bear market, and even chop markets in between. Now, it's worth saying where these numbers actually come from because I think that's kind of the whole point. Every one of the signals that I'm going to be talking about was run through the Squeeze Setups backtester that's built into our new platform. So it's this right here where you can punch in any stock. I repeated this exercise for the 600 plus stocks that we look at going back to 22 years. So you can run this on your own if you are curious about maybe particular stocks, particular stock data sets, etc. For this exercise, we're looking at the entire basket. Now, I logged 3 things for each signal. 1 was the deepest pullback, 2, how long the trade lasted, and 3, whether it ended green, this trade. Okay, so now let's test that first assumption. If you remember the two assumptions we made, the first assumption was, does the pullback even show up? So let's test that. Here's the distribution of how deep all 5,852 of these trades had in terms of their pullback depth. And honestly, the shape kind of answers it for us. Look how stacked it is to the left side. 29% of these trades never even dipped half an ATR. Add the next bucket and you're at 46%, almost half of the trades that never pulled back a full ATR at all. They simply just went from the time of our Slingshot Squeeze entry. And 9% never even printed a single red number, meaning no heat at all, simply green once you entered the position. So that first assumption, it doesn't really hold up, does it? Not even by a little. Almost half the time, the dip you're sitting there waiting to buy never actually came. And that's before we even get into whether any of those trades were good trades or bad trades. So now let's move on to assumption number 2, which was, is a deeper pullback really a better deal? Like you're getting this bigger discount on the same trade where you get to skew the risk to reward? Or is a deeper pullback actually a bad sign? So I took those same buckets and I asked this time a different question, which was, what was the win rate inside each one? And just watch the line. The shallowest trades won 97% of the time, meaning the smallest pullback. Then we have 84, then 73, then 67, and 51. And that deepest bucket, the trades that fell 3 ATR or more against you, the ones that look like quote unquote the biggest discount, those won only about 19% of the time and on average lost about 7%. Notice the win rate doesn't really bounce around, it just falls in a straight line the deeper the pullback gets. So assumption 2 isn't really just wrong, it's more backwards than anything else. A deeper pullback isn't a cheaper version of the same trade, it's a different, worse trade. So the discount that you've been trained to wait on, that common advice that we typically see, on average, it's actually your warning sign of a squeeze that may not be going the way that you think it's likely to go. Now you can boil both of those down into one simple split. Call a trade a runner if it never dipped a full ATR, and a dipper if it did. The runners are 46% of everything, and they won about 92% of the time. The dippers, the ones that actually give you the pullback that you've been waiting for, they won about 49% of the time, so a coin flip. And the typical one lost money. So if you were to say this in layman's terms, the trades that refuse to give you a pullback typically tend to be some of the best trades in the entire study going back more than 20 years. The ones that finally give you your wish, this deep pullback, they end up being a bit of more of a coin flip. So the pullback you're waiting for, it isn't getting you better entries. Honestly, it's quietly filtering out some of your better winners that ended up being the best account growers, if you will. Now, before I draw any big conclusion, I owe you one honest check, because a result this clean could just be a long bull market doing much of the work for us. So I split the 22 years into 5 different chunks and reran the same research exercise, and the results barely moved. In every single era, the runners won somewhere between 91.6 and 94.2% of the time. That includes the '08 financial crisis, COVID, and the quiet stretches in between. All of them landing in that same narrow band. The dippers just sat there at that same coin flip the whole way through, so it wasn't some bull market fluke is what I was able to gather from this. This is just how the setup behaves in both good markets and bad ones. Okay, so far, all of this is description. Now let me actually put a number on what this habit is costing you, and this is all designed to help make a behavioral change, and I think numbers help do that the best. We look at the same 22 years worth of data with the same slingshot squeeze, except this time I'm going to run this 3 different ways. 1, if you only buy the pullback, you compound to a return of about plus 1,962%. Pretty good. If you get in on every trigger now, and then you add on the dip when and if it comes, you compound to about plus 9,537%. Same exact signals, the only difference is whether you showed up for the runner. Waiting for that pullback skipped 2,710 of these trades. And the usual fix people reach for is just leave a limit order down at the dip, and that only fills you about 60% of the time. And the 40% it misses, those are the runners because they never come back down to your order. So the market fills you on the losers and leaves you behind on the winners. And again, you don't have to trust this big aggregate number. Just look at the same 22-year curve and you'll see what that stock, whatever stock it is that you're looking at, does in the backtester. And you can notice, is this the same curve that we're seeing? Or does this particular stock have its own personality with the squeeze that's a little bit different from this aggregate rating? All right, so what do you do with all of this information? Well, I can summarize it for you in the 3 takeaways that I took from this entire research exercise. Takeaway number 1. When we see the slingshot squeeze, it seems to be prudent and in our best interest to put on a starting position of some kind, even if it's a small starting position. We don't want to be on the sidelines for what tend to be some of these nicer squeeze runners. So that would be takeaway number 1, some sort of starting position. Takeaway number 2. If your trading style is similar to mine, which is no matter what, you like a good deal, and that good deal itch is satisfied with waiting for a pullback, well, the pullback to wait for seems to be a shallow pullback, something in the half to 1 ATR range. So that would be a good place to add to the initial starting position from takeaway number 1. So far we have takeaway 1, which is starting position, takeaway 2, which is look for the shallow pullbacks if you are looking for a pullback. Takeaway 3 is now about the deeper pullbacks. These are the ones greater than 2 ATR. Typically, in my head, this was a sign of, hey, we are getting a really nice discount. Really, the better way to reframe this isn't some sort of an excuse or a discount to average into. Rather, it's our first set of clues that the data is giving to us that's telling us that the squeeze isn't really going the way we think, and it would rather be better for us to exit this position because we don't tend to see pullbacks this deep work out in our favor. I hope you found this video helpful for those of you that are squeeze traders. If you'd like to learn more about this research or conduct your own for markets that you like to trade, check out our platform, squeezesetups.com. I'll leave a link in the description box below, along with a coupon code valid for the first 100 traders if you are interested at all. It'll be good through the end of June. Take care, everyone. Good luck trading, and I'll see you in our next update.